Hello everyone, welcome to The Financial Prophet. Today we're going to discuss all of the exciting things happening in the stock market. So, as always, please click that like, share, and subscribe button and make sure to stay with us until the very end. So last week we discussed the state of the trade war and why it would be in both China's and the United States' interests to make a solid and lasting trade deal. After all, trade tensions are detrimental to both countries as well as to the global trade order. Still, I maintain the position that these trade tensions are much worse for China than for the United States. In short, the US consumer may feel a pinch because of less variety and higher costs on some products. Nonetheless, the situation in China is that they are forced to shutter factories as the demand for US-related products drops. Now, let's discuss the US-UK trade deal for a minute here. It looks like a very constructive first step. We witnessed a favorable development with the UK trade deal. This dynamic is highly constructive. It demonstrates Western unity as two very important Western economies strike a solid trade partnership. This deal sends a loud and clear message to both allies and adversaries alike that while the US is open for business, it expects not just free but also fair and responsible trade. And its closest trading partner, the United Kingdom, stands firmly with the US. Also, it's possible that Japan, India, South Korea, and other trade deals could start dropping like dominoes. This could enable considerable market share gains for US corporations as India and other nations could lower their tariffs and other trade barriers, enabling more US goods to flow into significant international markets. Now, while a trade agreement with the EU may be more challenging, it will be achieved in my view. The EU relies heavily on the United States for its exports. Just think about how many Mercedes, Volkswagens, Audis, and BMWs Germany exports to the United States each year. You know how much? About $27.2 billion worth in 2024. Also, it's not just cars, as the EU exports a lot of pharmaceuticals and other heavy machinery to the United States. These three crucial segments, pharmaceuticals, cars, and machinery, accounted for nearly 50% of all US destined exports in 2024. Germany and France are the two most powerful economies in the European Union. Now, do you think they're going to want to get stuck with 25% tariffs on their automobiles or pharmaceuticals? That may potentially equate to about a 25% sales decline in the US, which could wipe out considerable portions of the German automakers' profits. We may see similar detrimental dynamics apply to France's and others' pharmaceutical industries. The EU should strive to negotiate a deal as it would be first and foremost in the EU's best interest. Also, based on the recent progress in Switzerland, it appears that China also wants to get more trade agreements and wants to return to the negotiating table. So let's talk about China and China's need for a deal. China may need to deal more than most. First, only China has been essentially locked out of the United States trading-wise. Do you realize what a disaster it is for the world's most considerable manufacturing economy to be locked out of the most significant consumer economy? China doesn't have anywhere else to send its excess manufacturing capacity. Also, it doesn't have a strong enough domestic consumer economy to pick up the slack. Therefore, it's facing considerable issues as factories shut down and people hit the streets. So, of course, China is happy to accept the United States olive branch and the 90-day lower tariff agreement. This is another constructive factor for markets, as this is an important first step in eventually hammering out a lasting trade agreement with China. Now, let's talk about what this actually means for markets. Stocks, they have been surging again. It seems that the White House created a problem, reaction, solution scenario. First, we saw the Liberation Day problem that the administration essentially created. Then we witnessed several reactions that were also driven by the White House. Now we're moving toward a solution phase that is potentially favorable for the United States. So looking at the S&P futures chart here, we've had an amazing run since around the 4,800 level bottom that we witnessed during the panic-driven sell-off following the post-liberation announcement. Yes, after the S&P 500 had a monster rally after stocks bottomed on April 7th. Now we're approaching the critical resistance level at 5,900 to 6,000, and the market may have a little bit of trouble getting over this resistance point in the near term, in my view. So instead of going over the 5,900 to 6,000 resistance right away, we may witness a mild pullback correction process first, during which the S&P 500 may decline to about the 5,700 support level, at which we should get a lot of dip buying interest, which would probably create another very substantial buying opportunity in the stock market, in my view. However, the fundamental factors, they have to align. The near-term challenge is that the market is becoming priced for perfection. Also, despite the recent positive developments, there are still substantial issues for markets ahead. We've had a positive earnings season, but many of the bellwether companies have reported earnings already. Therefore, what will be the catalyst to push stocks toward new all-time highs again so soon? Additionally, an economic slowdown is occurring, and no one has ruled out a recession yet. Despite having made progress on trade, we will likely see some negative effects in future quarters. Corporate profitability could cool, potentially leading to more choppiness during the summer. Now, we should also talk about stocks not moving up in a straight line. Now, given the relentless rise of the recent rally, there is a high probability of a summer pullback ahead. They say that you should sell in May and go away in some years. While selling in May this year would have been a mistake, some profit taking and hedging in late May or early June, mid-June, could be a solid strategy. Just as we witnessed sentiment shift from negative to positive in mid-April, we could witness sentiment souring again as we move into the slower summer months. This dynamic could arise due to worsening economic data and earnings, as well as other elements, and could lead to selling pressure in the slower summer months ahead. And also, we should discuss the Fed, as it could also participate in this slightly negative backdrop element in the near term. So the Fed has paused its monetary easing cycle, which it could become a problem as we advance. We've seen some better than expected jobs and other data in recent readings. Now, the probability for a July rate cut has decreased recently. In fact, the probabilities for a July rate cut have decreased to about 35%. Now, if we're discussing the potential for a September rate cut, there is about a 70% probability for a September rate cut. Now, we also have an FOMC event coming up on June 18th. So previously, the market anticipated that the Fed would likely cut in June, but the probability has dropped to below 10% now. So we see the Fed is more hawkish than the market anticipated, and we could continue seeing a similar dynamic play out as we advance. This may be the challenge that the market focuses on in the near term, as we need lower interest rates to improve growth, including the housing market, consumer spending, and other highly sensitive and critical areas. So, in closing, while the recent rally has been highly constructive and potentially illustrates that the April 7th bottom will stand, it's challenging to imagine that stocks will proceed to new all-time highs right away without experiencing a pullback. Therefore, the S&P 500, NASDAQ, and other stock market averages, they may face some considerable resistance soon, which could enable another pullback to transpire, which should create another excellent buying opportunity before we see an actual move to new all-time highs in the second half of this year. Now, we should consider that more trade deals should be in the pipeline. And despite the recent hawkishness, the FOMC should come around to easing rates relatively soon, probably in September. Moreover, there are tax cuts, deregulation, and other favorable catalysts on the horizon. Despite the potential for more near-term turbulence, I remain bullish on stocks in the intermediate and longer term. My S&P 500 year-end target remains 6,500. I thank you for watching my video. I hope that you enjoyed the profit report, and more importantly, I hope it helps you make more informed decisions going forward. I would also like to hear your comments, so please join the conversation in the comment section below. If you like this video, please click like, share, and subscribe to my channel. You can also join the Financial Profit, my exclusive investment community, which is seeking alpha's #1 service for proven portfolio profits. Thank you very much for watching. I hope that you benefited from watching my video. See you next time and have a great day.